Please switch off your volumes. We start today's market talk. This has been a Donald Trump's year, no doubt about it. No other person or event has even remotely come close to Trump's domination of the headlines. US is the world's largest economy and militarily the strongest. His tariffs clamp down on immigration, his insistence that other countries follow his rules affects countries across the globe. Now, how are markets likely to fare in the present scenario? I'll do a deep talk on this today. First is the US goal is no longer to maximize efficiency through open markets. They won't. Earlier, the thought process was let everybody grow, everybody make money. But nowadays, to secure national advantage and wield economic tools as instruments of coercion, with Trump simply pursuing this logic in its most unabashed form. So the goal is to secure national advantage and use the economic tools as instruments of coercion. This is what he's doing. The reason, number of reasons are there, but the major reason is rise of China as a strategic challenger. It has triggered alarm in the US, and Trump's policies are aimed at preserving the US hegemony. From tariffs to reshoring supply chains to sanctions, his policies are blunt, transactional form of economic statecraft. Now, our view or our belief were that we were counted as an essential counterweight to China, that all nations would woo our rising economic clout. But this view of India has been brutally brought down to the earth. It has become clear that the West views India through a transactional lens, arms sales, technology transfer, ISET, initiative on critical emerging technology, which covered defense, semiconductors, space, telecommunication, AI, biotech, etc. There were six specific verticals where US was cooperating with India. And what have we seen? Just 2 days back, reports emerged of a PAC Silica coalition for advanced AI and critical minerals. It has excluded India. Economic narrative was that as countries left China, they will come to India. Reality has been complex. Manufacturing has gone majorly to Vietnam, Mexico, or Thailand, where policies are more suited to business. FDI has fluctuated, other than Apple, which has come to India. And even in G20 and developing world, China remains their primary lender and infrastructure builder for all of them. That is the developing world via their Belt and Road Initiative. So they remain aligned with China. Now, coming to Indian equity indices have been range bound for some time now, and valuations of Indian equities continue to be expensive. I'll discuss this issue in detail today. Indian equities for over a year are underperforming most emerging market indices. The reason is basically earnings. Earning downgrades, earnings are slowing and growth is weak. Now the FY26 has been weak. We have grown around 7-8%. So there would be a low base. So now the expectation is because of the low base, the earnings may improve in FY27. Now talking about Nifty, it is trading at around 22 times. That is around one standard deviation higher than the average. While mid and small caps are much higher than plus one standard deviation. So too high for comfort, hence they are underperforming. Now FY26 overall earning growth is around 7 to 8%. FY27 we may get around 10 to 12 or 14% due to low base. Nobody knows. It depends on so many factors. Now coming to various specific sectors, consumer staples are floundering. They may give 6-7% growth maximum. Large cap IT may improve, depends on the management commentary as to what they are seeing, because they are right now growing at 2-3%. They may grow at 5-6% growth in a best case scenario. Accelerated growth will come from discretionary consumption, financials, and passenger vehicles. They are doing well. Now the biggest problem is capex was led by government and it grew at 20% CAGR from FY21 to 24. Now capex is at 11 to 14%, and that should also be difficult between FY25 and 27. This is leading to margin and working capital pressure and impacting PATs. So if you see the management commentary of all the companies, they are finding it a problem to get their money, or the government is not paying them, especially the ones which are doing the projects for the state governments. So remain negative on anything related to capex, cement and industrial sector. Private sector is not interested in capex other than in renewables, hotels, data centers, electric vehicles, biofuels, etc. So be worried about anything linked to capex, which is expensive right now. Now, coming to India-US trade deal, uh, 25% tariffs for importing crude from Russia getting removed is in the price right now. Up to 20%, if the tariff is brought down, market would be neutral. That is okay, fine. We will live with that. Below that will translate into greater optimism, and a status quo at percent will result in a sell-off in equities if the trade deal is not done by the year. That is the real problem, that expectations are pricing in some kind of a positive development by end of this year. Now, if it gets pushed to March, there would be a sell-off. Export sector will be impacted. Problem is the sectors which are exposed to the US exports are labor intensive and can lead to job losses followed by lower consumption growth. And weaker exports are leading to rupee depreciation, which is the biggest problem. As Fed will cut rates next year and dollar will depreciate against other currencies, FI's outflow should reverse. But it is not coming to India, it is going to China and other parts of the South Korea, etc. The reason is high valuation and low visibility on earnings is a perfect combination for India to underperform. And the world wants a piece of AI, and there is no AI related stock to buy in India. So, to sum up, what are the risks? First, our inflation is down, so we are cutting rate because crude is down. Now, if crude grows up, that's first risk. Second is rupee depreciation. I'll speak about rupee depreciation later. Third is if India US trade deal is delayed and tariffs don't come down, that will lead to a big sell off. AI bubble debate in the US plays out and US also sells off, so that will take all the world markets down. And if you see this year, government has done everything. They have cut rates, they have cut GST, they have given all kind of stimulus, etc. But now the government has nothing more to offer. So if the government stimulus stops, then again the consumption stops. So that is the issue, because you can give one-time stimulus, but after that, how do you follow it up? Now coming to rupee. So if you see here, USD INR depreciated around a percent. It has gone to around 90.54. Though I'll show you dollar index has eased. So it's a double whammy. Now what is happening is that dollar is coming down and rupee is still weakening. It is a double whammy because the rupee is weakening much more against rest of the currencies of the world. USD INR is elevated due to delay in the India-US trade deal. A rate cut has acted as a trigger also for rise in gold and silver prices. So we are importing a lot of gold and other stuff. So because of that, there is an increased demand for dollar by importers, and that is leading to further decline in the rupee. Now, RBI's $5 billion rupee buy sell swap should ease some pressure and provide liquidity, but it has to be, right now it is pointing towards a decline to at least 91 and then maybe 92. Now the other point is the government bond yields are going up, not coming down. And here we are talking about rate cuts, etc. So after the rate cut, so if you see, this is a weekly chart, we had a rate cut and the bond yields have gone up from 6.5, it has gone to nearly 6.6. So 10 basis point rise in the bond yield. So that shows that people are expecting government to borrow more. Now coming to FIDI data. So if you see here, in index futures, FIs hold 1.5 lakh short positions. So they remain bearish. But here, in terms of index options, they bought calls and sold puts. So they are turning bullish. And I'll show you in the monthly data also. Now coming to pros. the proprietary traders, they have around 8,000 long positions in index futures. But in terms of index options, they have sold calls and they have sold puts. But selling puts has been more. So basically, they are mildly bullish. Clients, they have around 99,000 odd long positions in index futures, so they are bullish. But they on Friday they sold calls and they bought puts in index option. So that means they are turning bearish. So the situation is changing now. FIs are turning bullish or covering their positions. Pros are mixed but slightly on the bullish side. And clients, which were generally mostly bullish, are now actually hedging their index futures positions by turning bearish in terms of index options. Now coming to this FIDI data for the month or so. So if you see here, from 1.69 lakh positions initially, it reduced to 87,000 or on 27, that was expiry day, and then it has increased to 1.5 lakh. So we are back to square one. But the days the Nifty does well are those days in which FIs are bullish in options. It's a very clear correlation. See, the days in which it is above 0.5% rise in the Nifty are the days on which FIs have turned bullish in terms of index option. That's a clear correlation. Otherwise, they are selling in cash and DIs are continuing to buy in cash. So that is normal. So it is all related to FI action, which is leading to rise oblique fall on index. Now coming to the US, uh, if you see S&P 500 and Nasdaq posted losses, but Dow Jones gained. The reason were two: less hawkish than expected Fed interest rate decision was offset by a slump in AI trade after disappointing quarterly reports from Oracle and Broadcom. Now what is happening is they are cutting rates, but here again, see, there is a decoupling from Fed's policy rate, like in India. In the US also, the bond yields are going up because markets are wanting higher returns to hold US debt. If I want to hold US debt for 10 years, I want higher rate of return because there is so much of risk of currency depreciation, of defaults, and so many other issues, and higher debt, inflation, and all those issues. Now, dollar index is correcting as was expected. It has come down to 98 because of the rate cuts, etc. So it is correcting. There is less demand for US bonds, etc. Gold has now again started an upward trajectory. It is now again heading higher. So once it breaks this 4,400 level, it will head to 5,000 now. At least in FI from the next year, you will see that kind of a demand because there is so much of demand for this from the emerging market central banks. Silver is on a different path now. It has consolidated after the last rise, decline, and now it is started going up because of requirement from both as by the central banks and from industrial demand. So now it is heading higher. It has on the Indian markets has reached 2 lakh, and this is where the money is moving nowadays. Coming to copper, there was some supply and demand mismatch. I told you last time it had corrected, but the demand remains strong. Bitcoin has corrected. It is selling off, and it is correlated to the AI trade, etc. in the US. Brent crude has declined. It has come down to 61 odd, less demand, better expectation of supply all over the world. S&P 500, if you see, it declined because the AI trade sold off, but it's still somewhere closer to its all-time high. Nasdaq, it has come down. It corrected around 2%, but it is still within this rising channel. So somewhere closer to this 20 EMA should be a level to say get in here. And Dow has made a fresh high because the balance of the US markets are doing well. Now, the another thing which I wanted to highlight about crude is, despite all those things happening with Venezuela and etc., it is not going up. It is coming down. Now, India VIX has declined. It has come down to around 10.11. So that means the the VIX or the people are getting too complacent about this issue, and the premiums are also much lower. So hence, people are trading more in options or buying options. That is a better way to say. Nifty 50 weekly chart. So if you see similar pattern as the last 2 weeks, weekly chart formed a candle with a small body and a long lower shadow, which reinforces the bullish intent at lower level. So at lower level, it gets bought. If you see the daily chart, for last say around 30 plus sessions, around 15 to 17 times Nifty has reversed from 26,000 level. So it keeps going up and keeps coming down, but it has been taking support. So if you see here at 50 EMA, so a consistent pattern of shallow corrections. This time index corrected around 2.5%, pulled over 8 sessions, and then pulled back. 50 EMA has provided support from here. So bullish intent seems to be intent. Now I think it will come down below 20 EMA next week, and then trade between the 20 and 50 EMA. So above 26,200 should be which should be immediate resistance, should be bullish. Then it can go to 26,350, 26,500, and support should be at this level of 25,750 to 700. Next 50, there is no strength. Lot of stocks are declining. So after Nifty is over, as I had brought out, as the market cap goes down, the performance is also going down in the stocks in Nifty 500 or 750 or whatever thing you take. Nifty Bank, similar chart, it has outperformed and it made the similar kind of a candle. But if you see here on the daily chart, it has not declined below the 20 EMA. So it has strength. And 59,000 is a good support. Above 59,000, it will be positive. 59,700, 59,800 is the resistance. Above this, 60,500, 61,000, and support at around 58,800, the level it made last week, is the area of support. Now, among the PSU banks, they saw some profit booking. Private banks are stepping up. So Axis Bank, etc., Federal Bank, IDFC First Bank are looking good in terms of momentum. IT also corrected, so it has corrected and it had gone up, but it had a green candle. So here there is a profit booking taking place. Metals are in clear momentum. It has broken out, given a strong technical breakout. So this is one where the rate cuts in the US are helping. And I think there is some talk of stimulus from China. Autos has bounced above the previous high. So it had declined, but it bounced back. So this is showing some momentum. FMCG is declining. There is no strength here. Not much is expected. It is now below the 100 EMA. Defense is also declining. People are not expecting much of an expenditure from the government, etc. The orders, if you see, are also not really big, which are coming to the defense companies. So it is declining now. Maybe there is a fund buying, etc., which is keeping it up. Otherwise, there is no momentum here. Mid-caps are above the previous high, so it is showing some momentum, this mid-cap select index. But the index which is really weak is the small cap index. This has declined, and micro caps have performed the worst. So this is the segment of the market from which you should be careful. If you talk about stocks, Axis Bank, I spoke about Muthoot because of gold prices. Chola Finance, they are looking good. So NBFCs are looking good because cost of funds should go down. But the other issue is markets are pricing in a possibility of a rate hike from Bank of Japan and carry trade unwinding. So next week should be affected because of this news. Now coming to stocks, HDFC Bank above 20 EMA, so it is good. Uh, it has to get above this 1020 mark. Reliance again consolidating around these levels, went down, recovered, but it has to go above this 1550, 1556 or levels where it is, and then head to 1600 to show some strength. The stock of last week was Hindustan Zinc, was up 12% because of its silver trade, etc. So the first level should be this previous high at around 575. That should be the first target, and if it crosses that, then it can head higher. But remember, this is a very volatile stock, so be careful. RSI is also reached around 67 odd, so it's not that kind of overbought and good volume. So there's a lot of interest here along with silver in Hindustan Zinc. I'll cover good interesting stocks. Aditya, Infotech. You must all be aware of the brand called CP Plus, the leading CCTV and security solutions brand in India with 30% market share in video surveillance market. It is positioned at the core of a multi-year demand cycle supported by the rising IP camera adoption and the shift towards STQC certified products. STQC is standardization, testing, and quality certification. This is the protocol which has been given by the government this year. So all products have to be basically aligned to this. This has been given for standardization, and people were importing a lot of cheap Chinese stuff in terms of cameras into India. So to prevent that, company has built one of the largest CCTV manufacturing capacity, which is expected to rise from 18 lakh units per month to around 20 lakh units per month by Q4 FY26. It is progressing on backward integration of components, including camera housings, cables, connectors, power electronics, and CCTV lenses. Its distribution network today spans across 1,000 plus distributors and 3,000 plus system integrators across 500 plus cities. A definitive agreement with L&T Semiconductor Technology. L&T, along with Aditya Infotech, will co-develop India's first indigenous IP systems on chips. IP is Internet Protocol-based surveillance and security solutions with Vision AI technology, which will be used in manufacturing of 9 million CP plus cameras over the next 3 years. It will likely be unveiling two new brands in December 25, namely IRA and Nexibu. These brands should present as an alternative to Chinese brand and will focus on mass markets, so cheaper ones than their normal CP plus brand. The market share has increased from 21% in FY25 to 31% in H1 FY26 and can reach 40% by FY28. Government mandate of installation of CCTV across schools and public infrastructure also supports long-term revenue visibility. CCTV camera is likely to move from nice to have to must have category now. And we have per capita CCTV cameras are pretty low in India right now. So they have a comprehensive portfolio providing end-to-end security solutions across verticals in terms of cameras, network video recorders, and other stuff. So they've got a lot of stuff related to this field: displays, central command and control solution, thermal camera, 4G cameras, etc.
मैं और आगे नहीं बोलूंगा कुछ भी.
Please switch off your volumes. Now, Aditya Infotech, it has strong competitive advantage. Brand, it has got the good brand CP Plus, IRA, Nexiview. A lot of branch offices, distributors, system integrators. Then exclusive brand outlets around 69. CP Plus Galaxy stores, experience centers 5, CP Plus World Center, manufacturing facilities, largest single capacity at Kadapa, Andhra Pradesh, around 18 odd million units per annum. Servicing capabilities, RMA centers, these are basically return material authorization and service request centers, and it has around 2,986 SKUs. If you see the P&L, it did around 37.5% revenue growth. EBITDA was up 157%. The EBITDA margin nearly doubled. Profit before tax was up to 35% and adjusted profit was up to 39%. So did well. It got listed only recently, so it is improved. And they are targeting around 3,900 to 4,100 crore of guidance for FY26, and EBITDA would be 10 to 11%, adjusted PAT 6 to 7%. So they are targeting good growth, year on year 25 to 30% year growth, EBITDA growth of 50%, and profit growth of 75% in this year. Overall, security industry is expected to grow at 16-70%. IP segment, that is internet protocol based surveillance and security solutions, because earlier there used to be an analog segment which used to have coaxial cables. Nowadays they are not using that. This one is expected to expand more rapidly at 25% plus, offering high value growth opportunities. We expect further market share gain for them. Uh, so if you see India camera market size is expected to go up around 18% CAGR, and share of IP cameras would increase and analog cameras will go down. So the margins are improving and those who are manufacturing themselves are doing better. So they are expected to do around 4,050 crore PNL or net sales, sorry, in this year with 10 odd percent margin, and margins are expected to improve. So they are expected to increase their sales by around 20-25% every year. Net income would be around 256 crore and increase slightly better in the future. So here we are talking about EPS of around 21 or 22 in FY26 and around 31 in FY27. Suppose they do around 30 in FY27 also. Uh, Net sales are expected to grow around 30%. They are targeting around 25 to 30%. And I think they will maintain around 20% at least, with increasing market share and increase of cameras on 16-18%, etc. And EBITDA path will also grow at CAGR of around 30%. EBITDA margins are also expected to improve. Now, this stock listed in August last year, around 1000 odd, and has been moving up and then has corrected in the recent correction. If you are seeing around the PAT is expected, sorry, the around 30 rupees FY27 is the PAT which is expected. So in my opinion, at around 1500, this is expensive because it's going around 20-30%, but it's a good business. So just keep it on your radar. And so every dip becomes a buying opportunity. It has given a decent dip. So if you get a dip now till end of the year, this should be a good opportunity to buy a business for a long term. Now coming to Affle, uh, this is a global technology company enabling AI-led solutions in digital advertising, driving performance across connected devices, delivers consumer recommendations and conversions through relevant mobile advertising for leading global brands. It's a ROI, return on investment driven CPCU, cost per converted user business model. So it is not based on views, but you have to convert the user, then only they get money. So businesses also like them. Apple consumer platform stack powers integrated consumer journey for marketers to drive high ROE. I'll show you they are using AI, and I'll show you how they are using AI ML also. Uh, they are constantly increasing their converted users every year, and strong over the last 5 years, strong revenue and EBITDA and PAT growth. So their business, if you see, 73% is coming in India and emerging markets. And now they're trying to increase their business in developed markets because the potential is higher there. So core business model is CPCU, cost per converted user. This means they only get paid when a user actually performs a high value action. That is, downloads an app, makes a purchase, or completes a KYC. They use proprietary AI algorithms to predict which user is most likely to convert and then target them across apps and websites. So they do a flywheel effect. It collects data on user behavior across apps. Then the AI gets smarter at predicting conversions. Advertisers get better ROI. They spend more. It gets more data. The AI gets even more smarter. So they are actually using the AI ML to improve their performance. They are aggressively expanding into developed markets, US, Europe, Japan, where ad rates are 5 to 10x higher. A recent 20 to 22% correction in stock prices was mainly due to lower than estimated CPCU revenue led by ad budgets shifting to Q3 from Q2 in the US amid tariff related uncertainty and partial real money gaming impact in India. Now, the impact on due to real money gaming is going to be around 17 to 18 crore per quarter to play out in Q3 and continue till H1 FY27 because it was banned. Near to key trigger would be good inorganic acquisitions as the company has rupees 146 crore 60 crore net cash on the books. Don't expect any meaningful impact of digital personal data protection rules 2025, which would restrict how much user data it can store oblique process. So that is one risk for them. To offset the RMG, that is real money gaming play down, slow down, it has aggressively diversified into other high growth verticals like e-commerce, education tech, and fintech. So if you see their financials, they did around 19% year-on-year growth in revenue. EBITDA was up around 28.9%. EBITDA margins improved by around 170 basis points. Profit after tax was up 20%. This is despite all the problems with real money gaming. PAT margins have improved. So they have done well even for this half of the year. And Q on Q also, they showed a decent growth and have reduced certain costs and all that. So the margins are good. Their model is very simple. You have to see how many, like in Q2, they did around 109 million number of conversions. Average CPCU has improved to 58 rupees. So 109 into 58 is directly their revenue. So they did around 631 or 632 crore. It's very simple. This is the major part of the revenue. So if you see, they did around 632 from here. And if you see here, they have done around 646. So it's very simple business to understand. Now, if this starts slowing down, and that is the reason why the stock was coming down, because the rate of growth has slightly slowed down here. Now, I'll just give an example how they are being used. Like Policy Bazaar wanted to increase its customer base for some specific products and increase the monthly booking rate. So they use the full funnel strategy for high lifetime value, new and existing user conversions. Use Apple's consumer platform for this. So they got good results. And I'll speak about this full funnel strategy. Now, there are three stages of Apple's full funnel strategy. They don't show ads, they use different technology stacks to move users down the funnel. So, in the upper funnel, top of the funnel, discovery and awareness, set the brand in front of the right people. Tech, Apple uses its out of the box experience and app next platforms. When you buy a new phone, recommended apps are often pre installed or suggested during setup. This discovers the user before they even visit an app store. Now, middle funnel engagement and intent. They turn viewers into interested users. Technology, their consumer intelligence platform uses AI to analyze 3 plus billion profiles. Action, if the user searches for, say, best sneakers on a vernacular local language site, Apple's AI identifies them as high intent. They then serve personalized rich media ads or video content to keep the brand top of the mind. Now, lower funnel conversion and transaction. So, bottom of the funnel, get the user to buy, register, or deposit. This is where the CPCU model comes into play. This is where the converted user part kicks in. Apple only charges the advertiser when the user takes a final action, like booking a flight or buying a shirt. This eliminates wastage for the brand. So they are able to get good price from the clients. Now, if you see in FY26, they're expected to do around 2,684 odd crore of net revenue, growth of around 18-20%. And the stock is correcting because this growth is slowing down because of this RMG effect and tariffs issue. Gross margins are improving. They are becoming more efficient. EBITDA margins have also improved. So they have cut down their cost, etc. And they are expected to do around 33 rupees EPS and around 40-41 in FY27. P is for FY27 wise, it is around 40 times and good cash flows business. If you see here, this stock it had gone up after this results of Q2 plus the effect of tariffs and real money gaming thing. The stock has corrected from 2200 odd to around 1600. So people would be watching for the Q3 and Q4 result, but this is a good business to have for long term. So somewhere closer to 1600, this is a decent buying opportunity for a good business with good cash flows. I have finished. We'll take questions now.